Good morning, ladies and gentlemen. I'm absolutely delighted to be here. Like Mike, I have teenage children. Unlike Mike, actually, Oil and Gas UK website, YouTube, is the only thing that I haven't blocked. As always, the results of the surveys have provided a lot of food for thought, not only for ourselves, our own organisation, but for the industry as a whole. I was very pleased to accept the invitation to come down here and bring the operator perspective to the results of the survey. As Mike took us through the key findings, they resonated very strongly with me in terms of the opportunities and the challenges in my own organisation. For those of you not familiar with Talisman Sinopec Energy UK Limited, we hold interest in 42 UKCS fields, operating 11 offshore installations and the floater terminal up in the Orkney Islands. We operate more oil fields in the UK sector than anyone else, and our net production in 2012 is 52,000 barrels a day, predominantly oil. The last year can only be described as a remarkable one in the history of our company. In December, Talisman Energy Incorporated enabled and executed a $1.5 billion deal with Sinopec, one of the world's leading energy companies, and recently ranked in the top 5 of the Fortune Global 500. The investment created what we are now today. To give you an insight into Sinopec and the magnitude of that company, they have 1.2 million employees and worldwide, and even have their own national TV station. Something that we aspire to having here in the UK. We run the UK business with Adax Petroleum, which is a wholly owned subsidiary of Sinopec Group and is based in Geneva. So the ultimate owner is based in Beijing, but day to day our dealings are with the team out there in Geneva. That makes communications effective and efficient. Until the investment in the JV company, Adax Petroleum focused its efforts supporting Sinopec mainly in Africa and the Middle East. Before I outline where our future lies and the challenges that we face, I'd like to give you a brief overview of our past. Talisman arrived in the North Sea in 1994 with an overarching business strategy to acquire and invest. We grabbed the headlines when we purchased the Beatrice, Buchan and Clyde fields from BP, and later Piper, Claymore and Tartan assets along with the floater terminal. Talisman's strategy was very different at this time. In fact, it was pioneering here in the UK, investing in mature fields unable to compete with, in the capital's portfolios, and investing in incremental developments such as infill drilling and subsea tiebacks. During this period, we executed some complex developments. Tweedsmuir, a 50-kilometre tieback, which required extensive modifications to the Piper Bravo platform, its host. We also developed a core competency of effectively combining and optimising business delivery from a melting pot of different cultures, emerging as one in Talisman. It's remarkable considering there's not a single legacy asset in the Talisman offshore facilities. Our UK production peaked at nearly 150,000 barrels in 2006-2007, and at the same time we also drilled 27 wells, a peak in performance that we'll be looking to replicate in the not too distant future. We were successful in generating shareholder value by reinvigorating mature assets through facility investment, infill drilling, on the back of a rising oil price. The UK was viewed as a core region in Talisman Energy. We were pioneers in the acquire and invest strategies, accessing first mover and early adopter competitive advantage. Where we blazed the trail, others soon followed. Key difference being that the followers, some of whom are in the room today, generally chose to operate a smaller number of assets than Talisman. As I mentioned earlier, we have now grown to operate 11 offshore assets plus floater, but this is a double-edged sword, and it requires a change in strategy. In early 2007, fluctuating oil prices and increasing competition meant that the acquisition trail was not sustainable. Talisman shifted to improving the way the existing assets operated, maximising cash flow from the portfolio. Talisman Energy Inc. naturally refocused capital investment to other large-scale value opportunities in an expanding global portfolio, leading to a reduced investment focus here in the UK. And so in 2012, the UK business found itself with the same challenges that Mike alluded to. Ageing assets requiring investment in maintenance and structural integrity, reduction in exploration and drilling activity, and significant and growing cost pressures in absolute dollar terms and per barrel of oil equivalent. Of course, these challenges, great opportunities have also been identified to improve safety and asset integrity, drill attractive infill wells and investing in major capital programmes, and to work more effectively with what is probably the most experienced, competent and capable supply chain in any upstream basin globally. At the beginning of 2012, we found ourselves with two options, invest or divest, and we found a strong partner and investor in Sinopec. We first visited Beijing in February 2012, and I was very impressed by how much the senior team out there knew about our business already. After a number of follow-up engagements in Beijing and Aberdeen, the SPA was signed in July and the joint venture transaction was completed in December, just a few months ago, leaving us with a strong sense of returning to our earlier pioneering days. The resultant JV company has attracted a great deal of interest throughout the sector. But what's in it for the shareholders and what does it mean for the industry? Let me elaborate. The structure is to align shareholders who are committed to unlocking potential through increased investment. Talisman Energy Inc. has retained 51%, with Sinopec Group picking up 49% equity interest in the UK business. Addax Petroleum UK is the organisation responsible for the governance and oversight of the 49% shareholder stake. So, what does the investment bring to the shareholders? The shareholders get an experienced team, a focused portfolio with an exploration upside, 3 core hubs, which I've alluded to earlier, control through high equity position, and a portfolio that is predominantly oil and therefore exposed to Brent oil pricing, which, as we'll all know in the room, closed at $111 yesterday. In summary, the Sinopec investment has removed uncertainty. Collectively, the joint venture partners will invest more in the UK, and Talisman alone was able to do more than $1 billion this year alone, leading to a more vibrant and ultimately more sustainable business. Good news, I think, for all the industry stakeholders. So what's the business focus for the JV company? Safety performance, particularly through investment in asset integrity, keeping oil and gas in the pipe and achieving or helping to achieve a step change in safety target of a 50% reduction in hydrocarbon releases this quarter. Focused and enhanced investment in our assets, improved operational performance, and executing major projects to extend field life and defer decommissioning, and unlocking additional infrastructure-led exploration activities. Over the next 4 years, the JV company will invest more than $500 million per year in the project supply chain, while our spend in the drilling and completion supply chain will be more than $250 million. The spend and these supply chains are crucial to the success of the new joint venture company. That all adds up to wells and subsurface teams with a very, very busy schedule. We also have a projects group with many interesting and challenging projects to review, and the key supply chain partners across the spectrum who have a major role to play in delivering future success. It is the collaboration of the joint venture company with our supply chain partners that will enable us to realise our long-term ambitions. I notice a few of our supply chain are actually in the room here today. To deliver the value in our portfolio, you will see us active in the market, searching for the best talent to join our growing company. Whether people join us as staff, consultants, contractors, service providers, we recognise that we require the best talent across the supply chain to enable our future and help us deliver it. We need a vibrant supply chain to enable our forward plans to come to fruition and deliver value to our shareholders. To put things into perspective, during 2013 we anticipate that the scale of the supply chains that underpin our projects, wells and operation businesses within our top 30 contracts will equate to more than 8,000 people. Only around 2,500 of these people will be direct employees of the joint venture company. The next 3 data points from the survey results are hugely relevant for the joint venture company as well as the wider industry. Production declining by 30% in 2 years. Investment at its highest in 3 decades. Supply chain and third-party costs continuing to rise. I'd like to bring our projects to life with one example, illustrating the key role that the brownfield allowance is playing in terms of enabling increased investment and subsequent value generation. In September last year, we became the first company in the UKCS to be awarded a significant brownfield allowance. This unlocked a huge part of Talisman Sinopec's future, enabling us to sanction our £1.6 billion Montrose area redevelopment, known as MAR. MAR involves the integration of established fields and related existing infrastructure, and 2 undeveloped fields, the Cayley and the Shaw. Over recent years, the Montrose and Arbroath hub has seen a production decline of 14% per annum and increased operating costs of more than 20% between 2010 and 2012. Without proactive intervention to positively impact both of these economic factors, near-term abandonment of the hub might well have been the outcome. The existing Montrose platform was originally installed in 1976 and is one of the oldest in the UKCS. With this new investment, Montrose and Arbroath will undergo major modifications, including the development of a new bridge-link platform. You can see in the photograph at the top left there, planned for installation in 2015. The development plan will also see the Cayley and Shaw fields being developed as subsea tiebacks to the bridge-link platform. A new modular drilling rig is also planned for the Montrose platform to unlock additional infill opportunities. Overall, the project will unlock around 100 million barrels of reserves and is expected to start production in 2016. Gross incremental production will peak at around 36,000 barrels per day. As the graph shows, the project extends the life of the hub beyond 2030. This type of field life extension is a critical medium and longer term value driver for ourselves, and I'm sure for many here in the room today. Just as importantly, in wider value terms, keeping infrastructure such as MAR open for business provides and enables incremental opportunities for others. The scale of our 2013 supply chain has already been presented, but it is interesting to place the MAR supply chains within this context. The project will create or support up to 2,000 UK jobs within the fabrication, construction, installation engineering, subsea engineering and drilling sectors. 70% of MAR's major contract spend has been committed to UK-based contractors. One example of this relates to the award of the £55 million jacket engineering, procurement and fabrication contract to Offshore Group Newcastle Limited, OGN. Many other UK-based contractors are also benefiting from MAR. The decision to sanction MAR is largely attributable to recognition from the government that a change was required in the fiscal regime to unlock further reserves in the UKCS. A high level of engagement with Treasury, DEC, in relation to the changes in brownfield allowances and frankly invaluable support from Oil and Gas UK and others has enabled us to sanction this project. It's also pleasing to see other operators sanctioning projects such as ourselves and citing positive government intervention as being the key to unlocking these investment decisions. So from an operator's perspective, we need to keep working closely with Treasury and DEC and continue to unlock further reserves and to drive investment activity in the UKCS. The key issue, which is within our control as an industry, is to effectively enable optimised execution of these projects. Execution in a way that enables future growth and activity levels. The hard work with our supply chain partners starts now. So that's a bit of history, a history lesson in the recent and distant past. I'd now like to look forward and consider how we might create a different future given constraints. I want to outline what I think are the key challenges. Improving recovery from existing fields, a rising cost environment, and exploration success rate. Which should be the most simple and assured oil to recover is the oil that sits behind pipe in existing reservoirs. And a backdrop of ageing infrastructure means that continued investment in integrity and facilities is a priority if we are to keep our people safe and maintain high site operating efficiencies needed to economically recover these volumes. The supply chain plays a key role in respect of innovation, efficiency and safety, and these are all keen contributors. We are fortunate to be involved in an industry that's experiencing a major resurgence in investments. Over the next 3 to 5 years, more projects will be sanctioned. This bodes well for the future of the UKCS business, but before we think about the delivery and execution of these projects, we need to focus on those already sanctioned and in the execution or execute phase today. To maintain an economic return, we must work together to ensure that rising costs do not render these opportunities uneconomic. In 2012, my company's supply chain spend was approximately $2 billion. This year, we expect to increase that by around 25%. The plan is for this increase in spend to be generated and premised on a growing activity set, and that's a big positive for the industry. But this positive could very quickly evaporate if the visible demand and supply imbalances that are apparent to all of us that care to look worsen in the short to medium term. The only outcome from this scenario is higher unit rates and a higher cost base for operators and contractors. My organisation has witnessed a considerable number of requests for rate increases between 15 and 20%. Annual increases being commonplace. As an industry, we can't afford to continue to absorb scale cost increases without this impacting current and future activity sets. Talisman Sinopec UK is committed to working with our supply chain partners. Ultimately, what we seek to identify is waste or inefficiently used resources, and then remove that waste from the cost base. This is not a profit-focused conversation. As I've already said, what we're looking for is a vibrant supply chain to enable success. The aim of this collaborative form of performance management is to enable mutual benefits to both operator and contractor of a reduced and more predictable cost base and improved margins. When UCOA morphed into Oil and Gas UK in 2007, the number of operators was, I believe, 24. There are now more than 50 operators who are members of Oil and Gas UK, and the net result of this is that contractors have more operators to deal with than ever before, but conversely less predictability about future demand. What we can be sure of is that this lack of predictability is on the increase. Can the operators help in this regard? Absolutely. Certainly my own organisation will be more predictable about our future demands on the supply chain. And it is my commitment that we'll spend more quality time communicating more effectively with that supply chain. Greater collaboration amongst operators, particularly those with similar interests and issues, has the potential to optimise use of supply chain resources. For example, logistics sharing opportunities brought on by the current helicopter outage, rig sharing, vessel sharing, service contractors where operators could pool demand in a single location. Some of these ideas and commitments may just allow us to change the game, and the prize is potentially enormous. So, in summary, sustained increased activity levels will be the key to the life extension of many of the facilities, and they will remain available to produce from existing fields or those that have yet to be discovered. Thank you very much.